Welcome back to Mostly Growth, the #1 podcast in product monetization. And Ben, you're joining us despite going out on a school night.
I know, I'm a naughty boy. I'm a naughty boy being up late on a school night. I saw the Flight of the Conchords, the raucous folk comedy band from New Zealand last night.
That's a real band? I thought that was like a joke TV show. I didn't know they actually play music.
Yeah, they were great.
Wow.
I can't believe they're still touring. Any new material?
No, it was essentially the same exact show from 10 years ago, which was their 10-year anniversary. So
I just saw Modest Mouse tickets are available in Boston, and I was thinking about going, and I was like, is it going to be the same hits from like 20 years ago? Which is what I'd want, but I have no idea if they have new music.
How'd you get there? Did you take the BART?
BART hasn't been extended that far to Southern California yet.
I forgot you haven't put in that Lightspeed rail.
The BART in LA. It's literally called Bay Area Rapid Transit.
La BART?
La BART. No, we drove, but we were coming from dinner beforehand. So I sprung for some primo parking.
Describe primo.
Yeah, I don't drive to stuff in Boston because that would be a nightmare. But like, what would parking set you back in LA?
So the general parking was $40 for like a lot. This is at the Greek Theater in Los Angeles, which is like one of the more like, it's like the lesser known Hollywood Bowl, the same sort of idea where it's like outside amphitheater type thing. But they had the option where you could park essentially right at the front door for $120. And so I decided to go for that. I was going with a buddy. I was like, hey, if you just pay me the general parking fee, I don't mind covering this because we're coming straight from dinner. We showed up a little bit late, like 15 minutes late. The opener started immediately when we sat down. So it was like the absolute perfect timing, no regrets.
And do you get out faster or are you just in a line behind all the other cars parked further away?
It was one of those things where they like closed the street, like half the street in front of the venue. And so after it ended, we like basically just
Scooted out.
Drove right out. Like we were parked in the street and then just drove right out. The people, were waving their little lightsaber things, being like, come on, keep going. Like I was not expecting to get out. I think it was 20 minutes from the show ending to being at home ready for bed.
So you paid 3x to be able to go to bed early. I think I like this. I think I like this play, Kyle.
When you put it that way, I would probably support that.
It's taken me, so for reference, I've seen a football game at SoFi Stadium in LA, and the general parking there is like $80. And in a garage, it took us like an hour and a half to get out of the garage.
Oh, dude, no way. Take my money. Yeah.
What's the upper limit for you guys? Like if you can get home in 20 minutes guaranteed, what's the like ceiling of what you'd pay?
All of it.
I feel like, yes, CJ is very price insensitive. Anything beyond $100 would feel really hard to justify. But I just take the T usually.
Yeah.
So I'm not used to driving places.
I tend to do it in like a ratio of what the normal thing would cost. So like if you look at an airline, usually the ratio between coach and like a really shitty middle seat and first class is 3x. It's like 2.5 to 3x. And I always thought that was like egregious. But now like that I'm traveling more, and if I'm going to be sitting there for 6 hours or something and like I could get work done and make money off of it, is that a good trade? I don't know. A, what's it relative to in my mind? And then B, what do you get for that? Which to you is going to bed early. I would personally value that a lot.
It's just like first class. It's ruined parking for me forever now where I'm like, wait, it can be this good?
Yeah. I think you made the right choice, but we're going to need some more sponsors to this podcast if you're listening.
Pay for Benny's primo parking.
Yeah.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyer and CFO CJ Gustafson break down how modern companies make money, covering pricing, monetization, and benchmarks in ways that make you better at your job. Tactics and playbooks for finance, product, and sales operators looking to be the CEO of their role. This is Mostly Growth.
Separate topic from parking pricing. I was meeting with an AI founder last week to talk about pricing, and they brought up that they've been currently putting 100% markup on their AI token costs, and yet procurement teams have been like throwing up all over that, like saying that's an egregious markup. Like, can't believe you would charge 100% markup. But the wild part is 100% markup really just means a 50% gross margins on just the token costs. which is way less than SaaS. And it's not an all-in margin when you factor in like customer success and all the
Yeah.
other things that they have to provide. And so this got me thinking, like, what is the end state for AI gross margins?
I just want to make that more real for listeners. So they're valuing their product at the same cost than it costs them to even make this thing run just based on inference and compute.
Well, that's what they've been testing, and customers are having a hard time being willing to pay that much of a markup or premium on the underlying AI.
I'm excited for this one because I've had some thoughts too on if we actually care for some of these companies, because a lot of podcasts and newsletters that I read, they've been talking about gross margin in isolation, but it's like, how do you know what's going on underneath within the OpEx and then the ending free cash flow profile? So I want to dig in.
Well, so I have a lot of data on what's happening with AI margins, and I want to talk about that. But maybe before we get into AI, like I was just curious, like what's the lowest margin business you can think of? It can be tech or outside of tech.
It's got to be the same business Spirit Airlines is in, right?
Yeah, airlines, I was going to say.
So airlines, I think, that's why I asked ChatGPT. I think that's about a 5 to 20, max 20% margin business, but probably a lot in the 5 to 10%.
Gross margin or profit margin?
That is gross margin. So 5 to 20% gross margin. So it doesn't provide a whole lot of wiggle room if your underlying costs increase by like 20%. You're kind of screwed. And so that's pretty low. But Costco is reportedly 11% gross margin via ChatGPT. I didn't check their S1 or 10Ks or any of that, but I'm hoping that's roughly correct. It's like 11% margin from Costco is a pretty low margin.
And what's their profit margin? I still think it's massive. So I don't know what voodoo magic they're doing.
Well, I think their profit comes from that executive club membership.
Oh, yeah, I forgot. Okay, well, that's a little bit misleading. Yeah.
That's like 100% margin.
That's 100%
I'm talking
gross
about
margin.
on for the products. It's they have this model of, we're going to charge basically at cost for the products, but then we're going to make it up on the membership fees.
So it's low gross margin very much by design.
Exactly. But the membership is your ticket to entry. I saw Walmart was more in the 20 to 30% range. So Costco is like undercutting them. But yeah, so you were mentioning restaurants, CJ. I think restaurants are really tough to give an apples to apples to because the margins are actually decently high on the food costs. So if you're just factoring the cost of food, like that's reasonable. But when you add in all of the experience around restaurants and like the fixed costs associated with running a restaurant, margins aren't actually high. But like on a food basis, there's probably 60, 70, 80%.
Yeah, I've talked to a couple of friends whose families are in the restaurant business. And whenever they start to talk about it, they talk about the rent cost first.
Yeah, so it's their problem is like the incremental margin is not too bad, but you gotta sell enough to even be in the black in the first place.
What about like I don't know, like a Zappos or something where you can buy shoes online?
So what I found is discount retailers tend to be in the 20 to 30% range, but then luxury retail is more in the 60 to even up to 90% range. So if you're if you're an Amazon or a Zappos, you're probably at a relatively small margin. I don't know, maybe 20, 25%. But, if you're a luxury brand, you can capture a lot more.
And when you're in that type of situation, the death knell is returns. I remember when we were at PartStack, one of our propositions was, hey, if you order the right part, you don't have to return it. And it's the second highest industry for returns. It's 19% of all parts that are ordered get sent back. Think about it. Like someone has to take like a dripping, like a oil filter or something. I don't even know. Not that I knew much about car parts, obviously. Like Zappos is, I think it was 22% of shoes that are ordered get sent back. Like imagine factoring that into your P&L.
Oh yeah, I always send back shoes. That's a really tough thing to buy online. So I guess in auto parts, what was the margin profile there?
On a good day, an auto parts supplier would make like 18%.
On a gross margin basis?
Yeah.
All right, so they're on the low. I mean, retail's tough from a margin perspective in general. Anything retail adjacent.
Luxury makes sense though. It's a higher price tag. I listened to the Acquired podcast on Ferrari, and they said that they have the highest gross margin out of any auto company out there.
I believe it. Yeah, I think luxury tends to be highest. Although what's interesting is like the Apples of the world have managed to be luxury from a margin perspective and mass market And that's like the dream spot to be in, but very hard to end up in that type of quadrant. The Ferraris of the world, what's the highest margin businesses you can think of?
I'm thinking of like a Google AdWords maybe.
Yeah, ad platforms, I think, tend to be 70-90% plus margin. I mean, there's not a whole lot of underlying costs there. Pharma was the one that my head went to because they have such big development costs. But then, when they're manufacturing the drug, that shouldn't cost them much, right?
I mean, there are multiple, not no bueno, but in Asana, like a productivity management tool, let's assume there's no AI in it. I think it's like 92% gross margin.
Oh, is that the highest in SaaS?
That's the highest I can remember. Yeah. 92, 93% Asana.
Well, your margin is my opportunity, CJ.
Wait, why didn't we include this? The highest gross margin and profit margin business is a parking lot. Ben, you interacted with one last night.
No, you're 100% correct. And this wasn't even a parking lot. This was like in the street. Like they had the parking lot and this is just, they shut down the street. So
it was the first 105% gross margin business.
Hey, the person waving their baton, it costs something, but that's
true.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run.
When I looked to set up my first CRM at Growth Unhinged, I knew I wanted something that was actually AI first. The world has evolved. Most CRMs are still stuck in the 90s. I found Lightfield, the CRM that remembers everything and does the work for you. It joins all my sales calls, reads my emails, and has the full context on every account. At this point, Lightfield knows my deals better than I do. I haven't had to set up a single CRM dashboard. Instead, I simply ask Lightfield questions like, which deals in my pipeline are most likely to close, or who do I need to follow up with today? It even automatically prepares me for meetings with a personalized daily briefing, and setup was quick and surprisingly painless. Lightfield is my sales coach, RevOps analyst, therapist, EA, all in one. See Lightfield for yourself with a 14-day free trial. Connecting data from your inbox takes just 5 minutes, and you can migrate in under an hour. Go to lightfield.app, that's LIGHTFIELD.app, and use code MOSTLYGROWTH to get 3 months free. When I went all in on my newsletter, Growth Unhinged, last year, I quickly decided it was time to make the switch to beehiiv. I chose beehiiv because they're serious about powering the internet's best newsletters. beehiiv's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on beehiiv. You can host webinars on beehiiv, and you can access beehiiv through the new MCP. I just use beehiiv's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, beehiiv is a no-brainer. Try beehiiv for free by going to beehiiv.com. That's BEEHIIV.com. Use Kyle30 for 30% off your first 3 months.
Okay, so we got these analogs. Now what?
We're very spoiled in tech for big gross margins and the expectation in software being, 70 to 90% or so. But I think what I wanted to illustrate here is that this is not guaranteed. There's a lot of businesses that are public companies or massive categories that are operating on much smaller margins. And for AI, it's not totally clear how things are going to play out. So I've got some initial data. I asked 230 companies, what's their target gross margin for AI capabilities? And one of the reasons why I think this is important is that in the survey, cost considerations was the number one factor that went into pricing. And so companies are actually literally using a cost plus model as the primary way they're pricing AI right now. for better or worse. And so the most common margin target is about 50%. So 31% of companies aim for between a 41 and 60% gross profit margin. And then interestingly, only 12% aim for a SaaS-like gross margin of above 80%. And then another 14% aimed for a margin of 20% or below, which is like a Costco style margin. And so things are kind of all over the map right now. But in general, these are not SaaS margin profiles.
They're not. And what I'm also curious is what their expectations around revenue growth are. Are these companies, in your experience, just from knowing your audience, that are hyper growth earlier stage companies, or do you think they're later stage companies that are bolting AI on and they already have a product that can afford for this to be a loss leader?
About half the companies in this survey were doing above 20 million ARR, the rest below that mark. And so these are generally companies that are fairly mature, have real revenue. The average growth rate in the survey was about 25% year on year. So these were not like early stage hyper growth companies that are buying market share. These are generally more mature companies that want to increase their growth rate, but they also need to think about, real profitability.
That's helpful context, which I'm trying to imply here that whatever product this is with AI, it's what they need to make the company go. This isn't like an afterthought. This is a real product that they're trying to build up.
Exactly. And so that founder I talked to, where they're pricing at a 100% markup, which means a 50% gross margin, that's literally like the median. That is the average. And I'm now just wondering like where things are going to go. Where's the long term here? And I'll maybe share a couple more examples. So for digging into the data, Anthropic's reportedly around a 40% gross margin. They've brought some of their projections down over time, but they still think margins could reach 77% in 2028. Now, I don't really trust that if they're continuously bringing margin expectations down, but still, they think it's possible. And then OpenAI is reportedly at around 33%, which was down from 40% in 2024. Lovable reported 35% gross margins in May 2025. So some of the larger AI players or the LLMs are more in that 30 to 40% range. And so we should also think about like there's the LLMs themselves, and then there's apps that build on top of the LLMs. And both want to be able to capture a margin.
Yeah, for the sake of this conversation, I think it's more interesting to look at like the Lovables of the world, which you said were around 35, and StackBlitz around 40%, because you trace it through their 35 and 40% margins because Anthropic and OpenAI are 40 and 35% margins.
Exactly. I mean, it's just the application layer is an interesting layer to focus on. And I think just in general, the more expensive AI is, it's harder to justify passing on a lot more cost to your customer. It's a very challenging thing to get right. So one of the things I wanted to ask you about, CJ, is like what should and should not be included in gross margin. So I've been noticing a trend with these AI apps. A lot of them have free tiers. The free tiers cost a lot of money to support free users, but they don't count free users under gross margins. They count that as like sales and marketing costs. Like what do you think should be included in this calculation?
When I die someday, Kyle, they're going to put on my gravestone, he told you what you should have in your gross margin.
That's what I'll put on your tombstone.
I break it up into 3 kind of buckets here. The first one is the labor associated with providing your service. So that's the customer support and many times customer success if they don't have any sort of linkage to revenue goals. Implementation should go up there too. So those are the 3 types of people type expenses that go up there. Before AI came about 50% of your COGS were related to labor. And then the other buckets would be any sort of API connectivity type stuff. So who are you paying to pass on their rails? If you're a payment processor, that would be the underlying like Visa, MasterCard fees. If you're a software provider, it could be like you're querying someone's database and have to pay a toll. And then you have your cloud hosting, which is traditionally your GCP, your AWS, your Azure. And then this third bucket has been expanded. Some would even say we should just call it a fourth bucket, and that is your AI costs for the models that are used to serve your customer, your end product. And I know we're using AI in everything now, so I'm specifically just talking about the stuff that goes in the product to serve them. I'm not necessarily talking about any AI you're using internally to develop the product or to make your team more efficient.
So would you include AI costs of supporting free users? Is that a cost of goods sold, or is that sales and marketing?
So that one, I think if you're being 100% academically honest, that is a cost of goods sold. If you put it in the sales and marketing category, I think it's a bit hand wavy. You're basically saying this is the cost to acquire a customer, when in reality, after you acquire that customer, you're still going to have to pay that, right? Like, in fact, after you acquire the customer, that cost is going to go back up to the top, and it's going to make your gross margin worse. So you can get away with that for a while, but I think long term, if you rely on customer acquisition through giving away inference, it's going to weigh down and burden your gross margin over time if you're successful.
So we should give folks that caveat, just that not all gross margin calculations are going to be the same, and like what you see in your business might not actually be apples to apples with someone else, even if it seems like it should be. Where I'm struggling is thinking about, our margin profiles for AI, are they going to be more like retail, like 20%, or are they going to be more like SaaS of 80%, or somewhere in the middle? One of the things that will impact this is that right now we're in this token maxing era, where spending a lot of money on AI products almost feels like, if you're not doing it, you're falling behind, and people don't seem to be that price sensitive around AI. And I have to imagine, like, we're not going to continue in token maxing era forever.
I don't think we will. And so I consider myself a bit of an earnings call historian. And I remember in Q4 of 2022, Frank Slootman of Snowflake hopped on the mic and he used the O word for the first time: cost optimization. If you think about their model, it's predicated on consumers using credits, consuming them. And after that, you saw this domino effect of all these other publicly traded companies being asked questions about optimization and how their customers were looking at the cost profiles. And so I don't think this goes on forever. I do think it will take some time to work itself through the system, because problem is people don't know how to measure the ROI yet, right? Like, people got their heads around measuring what the ROI was from having a data warehouse. And then they said, well, now we need to optimize the cost. Right now, we're still kind of in the mess around and find out stage.
With Snowflake's model, I think their idea was they have amazing expansion potential, and the expansion is tied to consumption. But customers aren't going to like go wall to wall with Snowflake if they think that it's a bad ROI. If they can take some short-term pain of optimizing that consumption, they'll get the long-term gain of like higher LTV, very sticky customers. But we certainly have not been through a wave of optimizations in AI, and I don't know if people have any of the visibility to optimize their spend on AI.
I'm actually seeing a bunch of compelling companies pop up that help you optimize your spend here. So one is called Cloud Capital, and what they're doing is they're helping you, similar to how, do you ever remember like when you had an AWS or GCP bill, it would just be like this lump of credits. You're like, oh, we spent a lot. But then you had to go a step further to say, okay, now we actually need to segment it into the workflows and like what's the infrastructure versus what's on the maintenance of the product versus net new. We need to get that visibility now on AI.
Yeah, there was this like a wave of products. There's a company called Cloud Health in Boston.
Yep.
That was like basically like cost visibility and cost management for AWS. I think they would charge like 1% of your AWS bill and promise to save you like 10% of your bill. And there was like a whole cottage industry of these players for compute because they weren't getting that type of data from AWS itself.
And I also don't think every company out there knows how powerful of a model they need for each task that they're trying to do. I was trying to draft something the other day. I was like, this is coming out like absolutely horrible. What is this? And I realized like I had like 5 models somehow of ChatGPT running in the background, and I flipped it to the latest one. I was like, this is 10 times better. So if you're doing like, hey, I forgot my password on a login on a customer support ticket, maybe you can use that crappy one that I was using and was like bewildered by how bad it was compared to today. But it's hard to know, do you really need 600 horsepower in order to get to your destination for some of this stuff?
When there is cost optimization, will this help or hurt margins?
Of who?
I mean, of the AI apps, of companies that are essentially delivering AI capabilities to customers.
My sense is it's going to be net neutral because they will get cost optimization from the underlying OpenAI and Anthropic and whatever else models, but then their customers will also ask for optimization. So in the end, I think optimization helps the end consumer of this. If you're on the application layer, you're going to have to rob Peter to pay Paul a bit in order to keep it in the same place.
Yeah, I think I can see a couple of directions here. Like, I think on the one hand, as customers optimize, that's often like optimizing their overall consumption. So not using as many AI tokens in general. And so like that in theory means that they might be willing to pay more per token if they're cutting half their token usage. But then the flip side of it is just as companies are paying a lot more attention to cost optimization, they're all of a sudden way more aware of the trade-offs between different models, and can we send some of these workflows to open source or local models to save money? And then that puts a lot of pressure on justifying your cost per credit or token or whatever it is. Like, it's really hard for you to justify charging a big premium if your customers are super aware of all the alternatives.
And we can get back to gross margin in a second, but just a PSA to people that cost optimization does not just mean using less of the tool you have. It's also getting rid of other tools. So I was talking to CFO recently, Kyle, and he said, my team is messing around with Lovable, Replit, and then he named 2 others. He said, next year, we only plan to have one of these. So cost optimization comes in multiple formats. It's not just turning down the volume on one vendor.
Although in a usage model, you can kind of have multiple vendors and like play them off of each other in a way that isn't so feasible in a like fixed subscription model. But I hear your point that people are gonna maybe start with multiple, see where there's the best performance and the best cost, and then they're gonna try to consolidate everything around one, and then maybe they get some volume discounting or better pricing for their scale and fewer redundant capabilities. All right, so the token maxing era, we're in that now. That's going to change the optimization era. The other open question for me is, are cheaper open source models going to be good enough? And like last year, it seemed like the answer was yes. And now this year, I'm not so sure.
First of all, I call it ROI maxing. So slight, more positive CJ today. I don't know if they'll be good enough. I think in some senses, nobody wants yesterday's newspaper, but I mean, when the tide goes down, sometimes companies are happy for what they can get at a certain price, especially if it's like we talked about on the prior podcast. How good do you have to be to overcome free? If there's someone out there who's going to give away some of this stuff and this compute for basically free, can it be 80% as good? Probably.
Yeah, when I think about from a vendor standpoint, so for the AI apps themselves, they could potentially do a little bit of shrinkflation, right? So they could charge one price and then realize, hey, we can deliver at 95% the quality at like half the cost by switching models, change out models under the hood, and then, see that margin kind of flow through to the bottom line.
Wait, I haven't heard the term shrinkflation in like 10 years. Is that when you get like a bag of Lay's potato chips and you're like, there's only 7 chips in here now?
Yeah, where it's like all air, so it looks like it's totally full, but then there's, like half the amount of Lay's chips.
Isn't there a term for the air that they put in it, like functional slack capacity? There's some like official term for it, but it's basically like a more scientific way to saying you're getting ripped off.
Yeah, the concept is like people like are maybe used to a certain price, and it's sometimes hard to raise prices, but you could keep the price the same and give the customer less and improve margins that way.
Yeah, my father-in-law said that at a place. He's like, the cheeseburgers around here definitely aren't 8 ounces anymore, but it's like the same price,
Exactly. Shrinkflation. So we'll see a shrinkflation era. And the other thing for me is, are enterprises going to push for bring your own tokens, or are they going to keep buying AI tokens through these application providers?
Oh, that's a really good one.
Because if they bring their own tokens, that kind of means like the AI costs are off the table for the vendor, but it also maybe means they're not really making money on the AI like they were before.
Wait, have any of the companies that you've talked to offered that as an option today at the application layer? BYOT?
I have seen a couple of companies offering it, but I have not seen anyone at scale doing that.
That's fascinating. It's kind of like we give you the car, but you got to fill the tank with gas.
Well, it's a lot of companies did this with infrastructure tools, right? If like instead of buying the infrastructure and the AWS bill, they would say, hey, we'll pay for your log management tool or whatever it is, but we're going to deploy it on our own private cloud and we'll pay our AWS bill or whatever it is. And so this has been happening in infra. I think it's just relatively new for AI.
I'm wondering though if that's cheaper, right? Because then it just matters how big your buying power is. as the standalone company. Like, I could see massive companies taking advantage of this, but if I'm little old me, I don't know if I can get better pricing power than like Post Hog if I'm using them on their credits. I'm guessing that they're buying up so much that it's a better rate than I can do.
Yeah, totally. I mean, I think that there's the buying power angle here. So maybe very large companies could save money, but yeah, your smaller companies are just not going to want to deal with the hassle and just have no buying power with the AI models. The other factor is like how much added value there is to buy tokens through the application. And so there maybe are applications that are good about figuring out when something should be open source or the premium model, and they maybe make that decision for you. And so if you just bring your own tokens, you're probably not going to have all that optimization layer built in, right? Or like they're not going to be as smart around using your token. So there's like, I think there's a question mark around how valuable like it is to the customer if they are on a BYOT or buy tokens through the vendor.
I can't believe I'm saying this, but the more and more I think about this gross margin question, the more I just come to the conclusion of, do we care? And I say that because the value of a business is predicated on its future free cash flows. And we're stopping at the gross margin line saying like, oh, this is shit. There's not much left over, but we haven't drawn it all the way down to profits and then a measure of free cash flow. And if you let that run out in perpetuity and you assume some terminal value here, I don't know what's in that bucket. I don't know the rest of the P&L. I think it's a different conversation if we're saying, what happens if like everybody wants to get to at least 25% profit margins? That's always been like the nirvana, because then you only need 15% percentage growth rate each year to get to rule of 40. Oh, that sounds pretty manageable actually at scale. If you can still get to a rule of 40, but your gross margin is pretty gross, is that okay? So I don't know. I just come back to some semblance of like what the enterprise value is here. And maybe we were lied to all along saying that software was valuable because it had high gross profits, even though a lot of these companies never got to free cash flow. Because at the end of the day, people are buying your product for what it will continue to do, not what it's just doing in that moment, which means you have to invest in R&D, which is usually the biggest capital crunch blocking you from getting to profitability.
The reason why we're talking about this is because as much as we've both said ARR is becoming increasingly meaningless in the age of AI, like companies are still bragging about their ARR. ARR is an important metric for investors. ARR growth is like the thing that everyone is focused on trying to deliver and then brag about in public. Because of this fixation on ARR, I think there's like some unnatural acts to try to get ARR, even if it's at the sacrifice of margin. When what really matters is like the overall profit dollars and the path to overall profitability. The margin could just be like the wrong thing to focus on, given what really matters.
Yeah, I think that's what we have to all come back to. What really matters here, right? Are we measuring the wrong thing?
Let me share an example of where I think things are going. So you know the company Toast in the restaurant tech space? So like a lot of restaurants use Toast. Toast has a subscription business line, a fintech business line, and a hardware and pro serve business line. Subscription business, 78% gross margins. Their hardware and pro serve business line, what's like kind of de minimis revenue, and it's negative gross margin. Their fintech business, which is a lot of payment processing, but some other stuff, 24% gross margins. So their revenue is very much fintech, but the margins, a lot of the margins come from the subscription SaaS revenue. And I just think that where we're going to go is that same kind of split. Like there's going to be the value add software that can still be high margin. There's going to be AI that becomes more of a pass through. That's like that 20-25% margin where you can make it up in revenue, but it's not super margin accretive. And then you probably have some other costs around the business that are more of an input to value. But my prediction for margins is 80-20 in that software and AI will bifurcate in terms of the margin profile. But where do you think things are going to go in 3 years?
It's a similar take than you. I would call it the age of non-consolidated financials, which means that you have to break out each of these. Toast does it because they're so different, but there are other companies out there that lump it all in, and then you just kind of have this blended gross margin. You don't really know what's going on. So I really like your analog of saying there are companies out there that have a payments aspect to it that has a different gross margin profile than the subscription part. But if you add them all together, they're stronger as a whole. And it's not like you would look at it and say, oh, I'm not going to do payments because there's a lower gross margin. It's like, well, you're leaving so much money on the table if you don't. So this cost for AI, it may just be the cost to do business and to supercharge the rest of it.
Exactly. Like you're not going to not sell someone AI just because it's low margin. It's just you're not having your entire business model dependent on AI being the only thing you make money from.
Well said.
All right. Well, we'll see. We'll circle back in 3 years.
I'll see you then. Wait, not AI. Ben, in 3 years, I want to come back and figure out what the parking prices are at the Greek Theater.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe and give it 5 stars. It only takes like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a good day.